Okay, so once again, my name is Mark. Yeah, so let's start from the website. The first time I was introduced to Titan, and I'm supposed to defend the company to someone, the basic reference point was the website, right? So when you get to the website speak to you about Forex. The first thing you will see are things moving on the platform, right? You can see apart from the homepage, you see prices moving. We are coming to understand all this very, very soon. And then as you can also see prices moving, why and where the price is moving from will also be explained to you, giving you live update or live information, right? We have the Titan Academy courses, right? So as a beginner, those who joined earlier, you can see a few videos running through the screen. Where will you get them? You can get them at the back office here. You just come to Introduction to Forex. You have access to those basic information presented to you. And then when you come to fundamentals or Forex fundamentals, most of you on the $30 subscription fee, these are the course outline. And the course outline is the pathway we're going to use or the roadmap we'll use to train you. Now, the beautiful thing is that it is good to make some references before class, right? So that as we keep giving the information, you'll be able to digest those information. When it comes to asking questions, you'll be able to know which question to ask, how to ask, and then you will be able to tell if you understand the project, right? So this is the curriculum. So we'll come back to the curriculum. Now, when you come to the Forex markets on the website, it also gives you an overview of the market. Then you come to trading, you have the time or take the time to read on both trading and then the copy trading, then the trading platform. Basically, these are the key major elements that I want us to be abreast of. As far as we will definitely recommend people to the platform to come and learn with us. All right, so with the curriculum, we have lesson one being introduction to Forex. We're going to break it down to a layman's language. All right. Before anything, I want to let you understand that Forex trading is not difficult as you've been hearing. Okay. It is not difficult. It's not riskier as you thought. So second is benefits to Forex trading. Then Forex basics, basics of Forex trading. Now, it's actually different from introduction to Forex. We have currency pairs. So what is a currency pair? We'll break down for you. In a Forex space, currencies don't move alone. They actually move with another currency pair. And just like we buy in the normal market, you use currency to exchange a commodity in the market, which means that the currency is at one side, then the commodity is also at the other side. We talk of going long and going short, or what is the meaning when you heard someone saying, I am going long or I am going short. Then we have types of traders. Now, we will all definitely hear we are not going to be the same type of trader. There are so many factors that are considered to determine or to let you know what type of trader you will be after all. A secret to consistent profit. Truthfully, when I first get the website, this was my first interesting aspect. What is that one thing that can keep you among the top 10% profitable traders? Positive expectancy in Forex trading or in trading. All right, at this point, emotions are part of it. Risk management, risk to reward ratio. That is where we're going to focus more of as well, so that you'll be able to make more money than the losses. All right, then we have implementing a trading plan. Now, this introduction is actually more than $1,000 at some places, right? So I think we have to give it to Titan our best, learn the skills, then make sure that we come out best, making a lot of money. Now we have principle of consistent profit in trading. Now, this topic is actually heavy because a lot of people, I hear people saying, I'm able to move $100 to $1,000, right? Some of them boldly add, period, they made that money, right? But they don't know how, what they actually did for they're able to make that profit. So you see them after that $1,000, they start going down and end up losing their money at a point. Then how to become a successful trader, right? So basically, this is our outline as far as the introduction to trading is concerned, as far as the fundamentals are concerned. All right, so basically, let me come to my notes and then start from somewhere for you. Now, there's one major question. If you have an answer, you can actually drop it in the chat box real quick. They will ask you, is forex trading a scam? That's the first question. And then some people are actually with curiosity and religiosity, they will ask you if forex trading is gambling, right? So what is your take? Is forex trading a gambling or is it a scam, right? Now, once you are giving me the answer, I want to be giving you my explanation, right? So let's start from gambling. What is gambling? Gambling is actually in a game that goes with time. All right. So football is 90 minutes. And then after 90 minutes, whatever you bid is either a win or it's a loss, right? But in the forex market, just like, let me just show you this. I've actually been holding this trade somewhere 7 a.m. Let me just look at the time here. Yeah, it's 10 a.m. And then I'm still holding, waiting for it to hit my target at the point, or wherever I'm okay to take my profit, I take my profit, right? So it means that you are not bound to any time as far as trading is concerned. So we will dispute the fact, we'll kick against the fact that trading is a scam, right? Now, let me also show you another example. I've actually analyzed gold US dollar from last year. That was somewhere I guess. And anybody that took this trade from this level and is still holding it, it means that the person is holding that trade over 5 months, right? Now, all these are actually categorized to the type of trader you also be, right? But let's understand the fact that trading is not a scam, neither it's gambling, right? Now, another thing that I will want to take off your mind is many people try to join platforms and then with the notion that they are trading, right? For the fact that you just made a decision, um, buying into a project without analyzing the project, and the project says that they are trading, you don't have the validation power to be able to determine if they are actually trading. Does not make you a trader. So you cannot use that data or that experience to conclude that trading is a scam. Now, the aspect of trading being a scam is when you make wrong decision. Now, we're going to teach you brokers. Titan is a broker on its own at the same time. Some of you also want to use external brokerage firm to trade. How do you actually identify those brokers to be able to make informed decision for yourself, right? Now, if you're able to understand that aspect, it means that you cannot go for a brokerage firm that is not real or that will affect our industry being a scam for you. Now, the aspect of trading that can be considered in a way as gambling is actually what we call binary option. But if you have the skill, it does not really mean it's a gambling. Why? Because you actually do prediction on time, right? So whatever you bid on it, once the time elapses, and you did not win or it didn't go in line with you, you are automatically losing that money, right? So that is what we can consider it trading as gambling. But when you become an expert trader, where you can actually understand the scope of the industry and the game, and you want to actually go for option trading, it's actually common in the Asia. They actually do more options and they do it to their best, right? That actually is still considered as trading. Now, the last point you could consider again as gambling is the fact that you don't have any infrastructure or system following, right? You just heard about trading. You don't have any, you didn't do any due diligence, you didn't get any skill, you just jump into it and then you start making money. Today you win, tomorrow you lose, and you become an addictive something that you keep repeatedly doing. That is actually gambling. So at that point, you are actually defining it as gambling. All right, so basically those are three major points I want to actually clear your mind so that you prepare to get the right skill and be able to make a good decision for us. Now, one of the most important things people say about trading is it is risky. My question for you is it risky? And actually, you did not have the experience, so you just believe that it's risky, right? But the point is that risk actually comes by experience, right? So for you to be able to define risk, it means that, or you define something being risky, it means that you are able to have some experience with it, right? So in trading, there is risk, but you are taught how to manage that risk. But I want to tell you that understanding risk is all by experience, basically, right? So as you climb the ladder, you will be able to know if it is actually risky or not. But aside that, there is a topic on its own called risk management, and that is actually coming to solve all the risk factors and risk problem for you. Now, what are the three major things you need to know before you start trading? All right. The first one is time. Okay. So time is very, very important when you want to be a Forex trader. Now, when I say time, I'm not talking about you being with your computer 24/7, like the whole day, the whole night. No, you can dedicate a time and stay with your machine, maybe 1 hour a day, 2 hours, 30 minutes, even 15 minutes. You can still go with the computer and make some informed income for yourself. I have a friend who trade only on Wednesdays. He trade one currency per Japanese yen per, and then he trade only for 2 hours. So he trade once a week, 2 hours in a week. He still makes his money, right? So the dedicated time is very, very important. Number two, you need patience, right? You need to actually practice. You need to give birth to patience and Patricia together, right? Now, not about waiting on the wrong side, but it's about waiting on the right side. Now, when I talk about right side or wrong side, not all patience are actually needed, right? Now, in trading, the aspect of patience we're going to talk about is after you've done your analysis, you are patient enough for price and market to go with your analysis, then you make decisions out of it, right? It means that you can actually make analysis or you get a setup and it can take 10 days for that setup to confirm your decision in the market, right? That is patience. Now, another side of patience is this particular trade that is currently running. So it gives a profit of $137. It's still pushing between the two, right? The point is that am I waiting for it to hit my target or not, right? So if it's going to hit my target, I have to wait. Now, what if I also get indicating factors that it's going to reverse and some way, somehow going to the opposite direction? Do I still need to wait? All right. Then also comes in your trading plan. All right. So all these are mechanisms that we're going to show you. Now, the last thing, which is the third on the list, is money. You need money to be able to trade, right? Now, aside plenty currency, the paper we handle is actually not money, that is currency. But money is actually from your mindset, how you program your mind, right? Now, for instance, you're only having $100 this evening, and I am telling you that by end of the year, you will be a $1 million richer. A lot of people will ask me how. That is the point, right? Probably if your pastor or your priest or reverend father is telling you, you will say amen. Okay, that's a different right now. That's a different when it comes to money, right? So you have to perceive it, and that perception or what you perceive will now come and be your guideline to take you through the journey. All right, so those are a few things that you need as far as psychology and then time is concerned. Now, then last thing are tools you need to become a trader, right? So what are the tools you need? Trading, you can use your tablet, you can use your mobile phone, and then you can use your laptop or desktop, right? Laptop or desktop is highly recommended, but you can still use a tablet or mobile phone to still use to trade, right? So those are the tools you need to trade. You need a good internet, like a very fast one, of course, for that matter. If you are already on this Zoom till now, I can see that your network is actually good, right? Once you are not being kicked off on and off, right? You're also going to have a trading account. And then to get a trading account, you need to get your real information, get KYC documentations at the same time, proof of residential identifications as well, so that they can be able to validate your residential address at the same time. So when we get to setting up a trading account, we're all going to understand why those things are needed as well. All right, so that is my introduction before we start trading. Now, aside the tools you need, you will need a notebook, okay, so that you can be able to pen down some informations. And this is the rule. You actually have two notebooks or one notepad and a notebook. Please do not say you want to type on your phone, right? Why? Because you might be typing on your phone and get distracted at a point, right? So if you have a single notebook, you can divide the notebook into two sections, right? Left and right, all right? So the left is actually going to be smaller, just like a margin. Now, what do you do at the left? As the class is going on, if there is something you don't understand, or there is a word you feel to go and do research or a question, you put it on the left-hand side, right? Then you make your notes on the right-hand side. After the class, you can actually make reference to that or ask your question. So once you have that, I think you are good to go. Now, if you don't have pen and paper with you right now, please on Wednesday, you'll make sure you actually get those pen and paper. All right, so let's go straight in. What is Forex or introduction to Forex? Okay, now I will actually just use this section to write. Okay, now, so when we're talking about Forex, is FOR. Okay, so we're talking about FOR. The EX. So it is actually the FOR is foreign, and then the EX is exchange, right? So foreign exchange. That is simple Forex. That is introduction to Forex. Now, when we talk about Forex, what are we talking about? It's all about international currencies trading against each other. At that point, one is actually buying against the other, and then the other is selling against the other. Now, we are going to use two local currencies right now. I know we have Nigerians here, we have Ghanaians here. So, for example, in Ghana, there is something called US dollar, and then it goes with Ghana cedis, right? Then in Nigeria, there is something called Naira, and then go against US dollar. Okay. Now, these two examples, actually, one is direct. US dollar, Ghana cedis is direct. Naira, US dollar is also direct in Nigeria. Okay. Now, there could be a three-way round effect where you have Ghana cedis to US dollar to Naira. That is also another section. All right. Now, most of you who heard about arbitrage trading or inter trading, this actually is what happened, right? Now, let's say you want to travel to Nigeria, okay, and you are going by a route. Once you get to Togo border, they'll ask you if you want to exchange your Ghana cedis to Naira. Why? Because you cannot spend cedis in Nigeria. That's point number one. Point number two, you can decide to exchange your Ghana cedis to dollar. Why? Because when you get to Nigeria, you can be able to exchange your dollar to naira or equally spend dollar in Nigeria. Okay. Now, when you are going in and out, there is transaction that will happen. Okay. And then there is a price you will buy or you will pay for. Now, for instance, in Ghana, right now, if we're talking about exchanging the dollar to cedis or cedis to dollar, let me just take the other way around. I want to buy $1. So how much do I need to pay? I'm going to pay about 13 cedis. Let's say 20 pesos. Okay, it's actually 12.7. So 12.7 Ghana cedis is equal to $1. Okay, now 12.7 Ghana cedis equal to $1. Now, do we trade every day? Yes, we do. We do it directly and indirectly. Okay. As far as you buy a commodity, you go to take Ghana cedis to buy water, you take naira to buy water, you've traded foreign exchange. Why? Because not all materials that come together to form that commodity you are purchasing is locally made, right? There's an exchange rate that happens one way or the other. Now, when you go to the bank, you'll see something like this. You'll see we are buying at a certain price, then we are selling at a certain price. Now you realize that the buying price will not be the same as the selling price. Okay. For example, let me use the last example. Last week, we have 10.3 and then 13. Okay. So it means that if you walk to that particular bank or the Forex Bureau, you're actually going to give them dollar at 10.3. But if you want to take dollar, they will sell it to you at what? 13.00. Now, when we subtract this, we'll be getting 2 cedis, 93, 98 pesos. Okay. Now, that balance actually is playing a role there. That balance is actually playing a role there. Now, Forex trading, like we know, is not a new thing. It's been there since centuries or for a few decades now. Now, the local one we do is money exchanging. Okay, that is the basic word somebody would use, money exchanging, right? So we knew that Muslims mostly do this, all right? Or we move to Forex bureaus and then we do that, okay? Now, when it comes to what we do on the internet, is the same approach, but there are few and many advantages in it, okay? Now, what are the advantages? At this point, you don't need regulation. Like Titan has already covered many of the regulations and the licenses covering you, the individual going to start that business. Now, if you are using other brokers, the brokers actually take care of your licentials and other regulations on your behalf as well. But should you want to start a Forex Bureau business right now in Ghana, one, you first need to register your business. You need to get a structure. Definitely, you need to factor in security. Okay, you need to factor in security. After that, you still have to go and get licentials from maybe Forex Bureaus Association of Ghana, this association, that association, that association. Then Security Exchange Commission will come in, IOCO will come in, Bank of Ghana will come in. Before we realize money actually is going in. And all these monies actually go with renewals. All these monies actually goes with renewals. So then you need equity. You need huge sum of money to be able to start the business. But in the foreign exchange market or the electronic foreign exchange market, all these methods are cut, including taxation. Imagine you being able to trade on Titan platform with as low as 10 US dollars, right? That's what we're talking about. As low as 100 US dollars, as low as 1,000 US dollars. That's what we're talking about. And this is trading. This is what we do. So your computer with the internet connects you to your broker, and your broker then puts you on the trading terminal, which Titan actually has a web terminal, and then the app version is also coming very soon. Or you are using an extended terminal, and the common one is the MetaTrader platform, which many brokers are equally trying to develop their own system due to third-party issues, sometimes server down and other stuff. So personally, I would highly recommend Titan Web Trader because that is an in-house system that they will make sure that server upkeep, everything is running very, very fast for your benefit as well. Right. So these are trading introduction. All right. Now we are integrating the benefits. All right. Now in trading, you also have the advantage to be able to use little money to control large sum of money. For example, let's say we're using euro and US dollar. Don't worry, we are going to break it down why it's euro and US dollar. Then they are quoting the price as 1.0394 or 91, right? Let me use 4. Okay, that is the price. And it is recommended that you can only buy 100,000 units. It is recommended that you can only buy 100,000 units. Right. So what is the 100,000 unit? The 100,000 unit means that you are multiplying 1.30, 1.0394, 1.0394 times 100,000. Okay, so you need about 103,904 dollars, $103,940,000. That is what you need to be able to buy 100,000 units of that asset. Right. Now you are using Titan as a brokerage firm. What is the advantage? The advantage is that you are only trading with $20 or $100 or $1,000. That is what is in your account. Titan now come in to cushion you. We call it you leveraged on them. And then with your little money you have, they give you a margin requirement to still be able to buy that quantity of currency required in the financial markets at that particular moment. Okay. Now, after you purchased, what happened? Price, let's say, move by 100 pips, which we are coming to understand as well, right? So after you purchase the 100,000 units, price then moved to 103. I'm actually doing the general multiplication, right? So let's say price moved to 104,040. Okay, so basically, you just have to subtract the current price because price actually adjusted in your favor. So you're multiplying the current price or subtract the current price from the previous price, right? So after you do the subtraction, the profit comes back to you. And the broker still goes away with the leverage they gave you. One of the biggest advantage in trading on the internet, right? Now, when it comes to Forex Bureau, you might have a friend to contact to actually rotate some fund. You might go to the bank to go and take some fund. It will never be free, right? Now, what do brokers get from you? The only thing they have or they will get from you is what we call the spread. All right. Now, when we come to the top here, the difference between the buying and the selling is what the bank benefits on a rotation basis. Okay. So those are some of the benefits of trading. Now, another benefit of trading is that you can trade anywhere, anytime, and it's a 24-hour market, right? So it's market open 10 p.m. and then closes 10 p.m. That is Sunday and Friday. It's 24-hour market, and everybody literally can be able to trade in the market. So these are few things you need to understand when it comes to advantages of trading. Now, the benefits are actually way more than the losses because you have the ability, you have the opportunity, have the control over your equity and your money, right? So to me, when we are talking about disadvantages, I will still boil it down to our own attitude of emotion or adding emotions to it. Okay? So that's our benefit of trading. Now let's come to basics, forex basics. Right now, when it comes to the basics of forex trading, it's actually very, very simple. Now, after introduction, you need to know a few terminologies. Okay. Now, the terminologies are words or jargons we use in the forex market, just like in the medical space, in the security or the army, they have some terms that you an ordinary person you wouldn't be able to understand, right? So, what are some of the terms? The first one is bull or long. So you hear about I am going bullish or I am going long. What does it mean? Now, on the forex space, we actually deal with charts, okay? And on that chart, we have what we call currency pairs, okay? So currency pair, we are actually talking about a pair of shoe, a pair of sandals, a pair of earrings, anything that actually has left and right. So literally, that is what we're talking about when we're talking about currency pair, right? Now, what's the most common currency pair you know? Definitely, we are going to mention euro and US dollar. Okay, so slash US dollar, right? Now, personally, I love to trade gold, so I'll add it, gold, and then US dollar. Okay, I'm actually going to add gold, US dollar, right? Now, this is actually a currency pair. Okay. Now, when we are talking about it is going long, we are only saying that the chart needs to go up or I am buying. Okay. So let me now add it. This means buying. Okay. Now, the other side, let me slash this. Okay. So bull, long is equivalent to buying. So if you hear bull, if you hear long, please, we are talking about buying. Okay, you may sometimes not see buy, right? Now we have them or bearish, okay, and then or short, okay, it's equal to selling. So at this point, you are expecting the chart to actually go downward. That is what we're talking about when we say a bear market or a short market or a selling market. All right. Now, when we say we are going bearish, it's different from market is bearish. Okay. For instance, those who are actually dealing with Bitcoin and US dollar, you realize that people bought it at 60,000 US dollars and prices would start as almost 15,000, right? So at that time, the market was bearish. Okay. Now, even though the market is bearish, people are actually taking bull or long position in it on short-term basis, right? So that is also one important thing that we need to take advantage of as far as decision making in the financial market is concerned. One of the major terminology you ever hear faster and so fast is bull bear, long short. You hardly hear buying and selling, right? Now, before then, I want to say something to you about advantages of traders. Okay, now as you are coming to trade, you are wondering why do I need to trade, right? Now, traders actually have two opportunities. Traders actually have two opportunities, and investors literally have one opportunity, right? Now, what do I mean by this? For example, let's say gold US dollar, right? An investor's prediction is, or investors will always want, as far as I put in my money, I want market to keep going up. So they are one-sided people. Their hope is always it should go up, right? Now, when markets start coming down, you see investors complaining. right? When markets start coming down, you see investors complaining, right? So those holding stock, you hear something, or many of us are hearing recession, recession, recession. Why are they actually crying of recession? They are crying of recession because most of investment prices will be going down. Stocks will be going down. Stocks will start falling. Now, as a trader, whether it is falling or it is rising, you have the opportunity to make a decision and still make money. For example, this is gold, and then as it was selling this way, my opportunity is to look for sell entries. Okay, so investors wouldn't be happy as gold is pushing down. They will now be happy as it is going up. All right, so a trader will finish selling and then look for a reason of price rotation and buy. So when you are a trader, you stand to earn as an investor. At the same time, you stand to earn as a trader because you take advantage of both directions of the market and then you make enough money out of it, right? So I am a proud trader and I will still be a trader. Hence, your decision to be part of Titan is going to be one of the best for you. Why? Why? Because Titan is not just going to stay on one side of the game, right? They are staying at two sides of the game. They trade when the market is going up, and then they trade when the market is going down. So as recession is here, what is happening is that, or what is going to happen is that any stock that will crash, a trader will actually analyze it and sell it as it crashed. He or she will make money. I hope you're enjoying it and you want to be a trader like myself. All right. So let's continue with the terminologies as well. Now, there are a few things you also need to know. One of them is called PEEP, right? This is a terminology and it's all part of the basis. Now, when we are talking of a PEEP, what do you mean? And this is one of the major things that calculates our profit or loss for us, okay? The ability and the movement of price, the change in price. So that is all about P. So for example, let's say price is 1.0345, okay? Price is 1.0238, okay? That's what actually type. And then after a few minutes, price now jumped from 1.02 and then come to 3.5. Okay, now you realize that the top value is not the same as the down value, right? So we are saying that price reduced by 3, the smallest value, price changed by 3. So that is 3 pips. Okay, so the pip move from the left-hand side towards the right-hand side towards the left-hand side, right? So it also goes with decimal places. This is ones, and then tens and hundreds. So basically, if I said I made 100 pip profit, I'm actually talking about price have gone into my direction on the 100th level, or price move in the 100 pips direction for me. Now, when it goes negative, then it's also the same by my price or market go against me, negative 100. It means that you are losing 100 pip. Now, more pip have a reaction or a calculation basis to actually determine profit. Okay, so we also have what we call lot size. Okay, now when we're talking about lot size, we are talking about a proportion of your equity going to work, a proportion of your equity going to work, and it is going to work in relation to your PIP value, right? So for example, we all can enter the same trade, same time, but as far as our lot sizes are not the same, we will all not make the same profits, right? Percentage-wise, we will, but value-wise, we won't. Now, lot sizes and understanding each algorithm is very, very important because that is actually where many people lose money, right? I know few companies that people say they are learning trading, and then you see them on, let's say, $100 account, and they are trading with one lot size, one standard lot size. And that alone tells you that the foundation is not right. Right now, our foundation is right. That is why we taking introduction very, very important. We taking the basis into consideration. Right now, lot sizes actually goes with your equity, and then we have recommended lot sizes as far as your account sizes is concerned, and that is actually going to determine your losses or your win per trade. Now, that actually also factor into what we call risk management because how much are you willing to risk per trade? So lot size is very important. On currency pairs, the minimum lot size is 0.01. The minimum lot size is 0.01, and it goes as high as your equity and the type of brokerage you are using or the type of broker you are actually using. But as far as you have an equity less than or $100 and below, your safe environment is 0.01. Your safe environment is 0.01. Now, when we get into risk management, we will be able to understand why you need to be within that range. Now, how do you calculate your profit? Your profit will be calculated based on your PIP value multiplied by your lot size. So that will be equal to your profit. Okay. So if I enter a trade with 0.01 and the market move in my favor 100 pips or 1,000 pips, I just have to multiply that 1,000 by 0.01 or that 100 by 0.01, then it actually gives me my profit I am making in trading. Now, in those days, in the olden days when trading actually started, we have to do calculation for all of these things, but literally, one way or the other, MetaTrader now does most of the calculations for you, where it's becoming more simpler than the previous days. Now we also have what we call spread. We also have what we call spread. Okay, so spread is very important, and when we look at our algorithm system, Titan algorithm system, there is a point in it where they tell you that it connects to international servers, and then with high speed of 0.04%, 0.04 seconds per transaction. Now, what it means is that the 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 robots connect to the big market, right? The big data, where the Morgans, where the Rockefellers, where the Rothschilds and German banks, all the huge banks are actually buying their quotations from. The bot is able to access the same price. All right. Now, when you are able to access the same price and you are reselling, it means that you have a huge spread benefit. Okay. Now, let's come to a broker's point of view. Now, the first profit brokers make is from the spread, right? Now, it's all about the buying price and the selling price. That difference between the buying price and the selling price. And it also goes with what we call the PIP. Now, if you are dealing with a broker that is charging you, let's say, maybe 20 pips, and then you meet a broker that is charging you 1 pip, the highly recommended one is the 1 pip. Why? Because it means that if your loss size is 0.01, once price move in your favor 1, you have paid for your spread, right? Now we pay the spread, right? So anytime you enter a trade, the first thing you see is negative. That first negative is actually the spread. So markets have to move across the spread then you can be able to see your net profit. Okay, so we also have ways that you can identify brokers with the best spread at the same time, right? Then when we come to types of brokers, we'll be able to break it down to know why all these are actually necessary. It has to get to that point where if you don't understand spread and how to deal with it, you will be on the other side making money for the brokers, right? So you and I can enter the same trade, same lot size. We had the same peep. Maybe market moved like 1,000 peep in all of us our favor. We are using the same everything the same. We enter at the same time, right? I can close the trade with $100 profit, and then you will close the trade with $80 profit. The problem at that point is the broker you choose. That is why it is always recommended you take time to understand conditions of brokers before you make decision to trade on their platform. All right, so if you are following and if you are getting value for your time, you can just say yes in the platform. Let me know you are actually following me. All right, then we also have what we call orders and then limit orders. Now, when we are actually talking about orders, it's all about giving command. Okay. Now, what order is all about giving a command, right? So basically, we have types of orders when it comes to trading, right? Now, you have two types of orders. You have the limit order, and then we have the stop order. Okay, those are the two types. Now, this aspect of training is more or less like the interesting aspect of me. Why? Because I hear people giving an excuse. I work at a bank and I don't have time to learn trading. I'm a teacher, so I can't trade. But that is not the truth. We have what we call limits or stop order. We call them pending orders. Okay. Now, when we talk about pending orders, this is what it means. You analyze the market. Let's say you analyze the market Friday after school. Market actually close at 10 p.m. You see market reaction. You see the nature of the market. You forecast direction of the market, and you are able to know the decision market will make. But you'll be at work. So price did not actually get to your price. Market did not get to where you want to buy or sell. So what you can do is that you can set limit orders, okay? Or you can set stop orders. Once price gets to those places, whether your internet is on, your machine is off, as far as you place the order and leave, wherever you go, you set all your parameters right. Once price gets there, it is the responsibility of the broker to pick the trade for you. Hence, everybody can trade Forex. Okay, all right. Now let's delve into it. Let me break it down for you. This one, I have to teach it like maybe multiple times for you to get it, right? So if you don't understand it now, don't worry, I'll retreat it again. Okay, now when we're talking about orders, this has two lines. Okay, let me draw three lines. Okay, then I'll put another one in the center like this. All right. So let's say you do analysis, okay, prices, let me say market is here. Don't worry, we're going to understand all these things. Market is here, and then you are going to work. But you believe that market will actually come down to somewhere this level before buying. Okay, price is currently here. And then based on your analysis, you projected or you forecast that price will come below or come down a little bit before it goes up. So what do you do? Now, you can't also stay with the markets until price gets there, and you don't know when it will get there. So what you can do is to put a sell limit order there, right? So what you do is that you're going to put a sell limit order there. Now, once you put a sell limit order there, you also put what we call stop loss and take profit. Those are the 2 points I'm going to after limit order. You put your stop loss and take profit over there. All right. Now, after you put your stop loss and take profit over there, what are the probabilities? The probability is price reversing there and moving towards your direction. The second probability is price never gets there at all. It only continues going where it went. The third probability is price gets there, pick your trade, and hit your take profit. The last probability is price gets to your order place and hit your stop loss. The medium, which is no probability, is that price picks your trade and price is between your take profit and your entry price. Or price picks your trade and is between your entry price and your stop loss. Those are the probabilities, right? That is why once you understand your risk management effect, you will be able to understand how to go with all these, that you can even put spending orders and still trade safely. That is number one. Number two is price is actually moving up nicely, and then you have a layer. You have a level, and you anticipate, or your analysis, or per your analysis, when price break that level, market will keep going up. When price break that level, market will keep going up. So what do you do at that level? What you do at that level is to set sell stop. So at that point, you are going to sell stop. Okay, sorry. This is actually a buy stop, not sell stop. Sell stop will be at the top. So this area, you are going to set what we call a buy stop. Okay, all right. So this will actually be here, and then this will be here. Okay, so price is actually moving from the bottom to the top. So we set a buy limit because we expect it to come back before going up. All right, sorry for the turning around of it. Now, as price is currently, you are expecting that when it breaks the median orange line, it is going to keep going up. Then you are going to put a buy stop there. All right. So as far as price gets there, your trade will trigger for you. As far as price gets there, your trade will trigger for you. So that is what we call a buy stop. Now, the opposite of those two is actually the sell stop and then the sell limit order, right? Now, the sell limit order equally means that, let's say price is here, currently here, and then per your analysis, price have to come back to this level before selling. Okay, so you're actually going to put your sell limit order above where price is currently. You put your buy limit order above where price was, because below where price is, you put your sell limit order above where price is. Okay, sorry for that noise. It's corrected now. So basically, that is how we set pending orders. Like I said, we are going to talk over it for a little while, like a number of times, so that you'll be able to get the insight and get the understanding of it as well. So that is sell limits. Just put it at this one side of your note. We have the sell limit order. We have the sell stop order. We have the buy limit order, and we have the buy stop order. If you can, you can equally screenshot it as well. You can screenshot it as well, right? So basically, that is what we call pending orders. That's what we call pending orders, right? Okay. Now, the next point is stop loss and take profit. Those are two major points as well. On that basis, we have stop loss, then we have take profits. All right, now what is a stop loss? A stop loss is a provision you made when you do analysis. Why will you do a provision when you do analysis? The market actually is dynamic, right? There are some factors that come into the market to play that we might not have power over it. For example, we have what we call fundamental analysis. You are in Ghana and then you are trading. Then your assets you are trading include US dollar. Now your analysis says buy, and then price is actually buying, and you were not aware that President Joe Biden is coming to make a speech. All right. So as he makes the speech, it triggers the direction of US dollar. Right. That can actually make US dollar to go against you. Right. Now, if you did not set stop loss, it means that market can go against you to the extent that your capital or your equity you're using to trade will finish. Right. So you put stop loss to pushing your losses in case market change direction against you. Now, stop losses are very important because it is the first primary way to lose your money. The first and the basic way to lose your money all in a day. Okay? Aside your lot size, understanding lot size, another important thing is to set a stop loss, right? Stop loss also helps you define how much you are willing to lose from yourself, how much you are willing to lose by yourself in case market did not go well with you. All right, now let's take our normal business strategies we do. I want to sell water, and I anticipated that when I go to the market, I'll sell all the water. Then as I was walking, I kick maybe a stick and I fell down. Then the water I'm carrying burst. That is stop loss. But in trading, you are aware. In the traditional business, you have no idea. You did not anticipate any negative thing that could happen to your business. Okay? But in trading, we help you anticipate what would happen. So you prepare for it. And that is what we call stop loss, right? It's an essential thing. Now, a lot of you who tried trading before, some people don't like to use stop losses. They will tell you that it is not a good idea, right? It's not true. It is not true that using stop loss is a bad idea. Please, you must always use stop loss because it will save you a lot. Please, can you guys see my screen? Can you see my screen, please?
Yes, we can see.
Okay, all right, thank you. I just want to be sure. Okay, thank you for that. All right. Now,
yeah, we can see your screen, sir.
thank you. Now, in the same stop loss, you will hear people telling you that it is not a good idea to stop loss. Just a moment. Just have to do that settings. Right. Okay. Taking care of. All right. Sorry about that distraction. Now, people will tell you it's not a good idea to set stop loss, but it's not true. They will use words like market will come and hit your stop loss and go in your favor, right? So we are able to teach you how to set your stop loss in a way that market will not come and hit it and still go towards your direction, right? Whether market will come and hit it and still go towards your direction or not, the first rule of a trader is to protect his equity. The first rule of a trader is to protect his equity, right? That is the most important thing, right? And stop loss does that. That is its work. Number two, you can tell yourself, oh, let me just be monitoring it. I'm not going anywhere. Then all of a sudden, you feel too wee-wee. You have stomach upset, like something happened. At that time, as nature is calling, you will definitely forget you are in a trade. Okay. And in that seconds, market can change direction. In that seconds, market can change direction. Okay. So it's very important. Another example is that your phone can just fall from your hand and break. The screen will break, right? And it will take you time to get to the referrer to fix it. That is if you will still fix it immediately, right? So if you set stop loss, regardless of the situation, the rest of the money is safe. Those of us using prepaid, prepaid can finish anytime. In Nigeria, my lovely second country, power is not stable, right? So definitely your network can go off, light goes off, power goes off, your prepaid finish. Any disaster, natural disaster, that is beyond your control. Very important. Now, the other side is take profit. Now, the take profit is actually a good thing. Now, the other reason why people don't use take profit is because they want to be greedy, right? Oh, what if it's still going to go in my favor? Right? What if it's still going to go my way? Now, these are things that make people not to set take profit. Now, the danger also not setting take profit is the fact that you could enter the trade, you are seeing profit nicely, and market reverses against you or going the other side for you. That's also another point. Okay. Now, your target is that I bought at 3. So I will close it at 10. That's your target, right? But at that point where you left the phone, or you forget your phone, or you just went out, or any of these unforeseen circumstances appeared, before you realize the market passed where you want to take profit and then coming against you again, right? So you'll be like, why? And you start blaming a lot of stuff. You know, some people blame to the extent that they blame their gods or their enemies, but that is not the point. All right. These are basic rules that you should be able to understand. You should be able to take the basic element to save you from becoming adding emotion to the game at the same time. Okay. Stop loss and take profit. Then the next point, which will be the last before we go, is margin. Margin. Now, margin is the amount of capital in your account that serves as collateral when you use leverage, right? Now, let me use the current data moving right now. So as this trade is running, those of you using mobile phone, please, you can zoom out a little to just see what I'm coming to explain here. Right, so the equity in the account is 9,119.90. That's the balance. And then the equity is actually 9,032 2.10. Okay. Then we have a margin of 115.6. Then we also have a free margin of 9117.3. You also have margin level of 7986.33. Right. What it means is this: the account is $9,000, and then I am using a leverage of 1 to 1,000, right? That's the leverage I am using. So aside that, how much or what quantity of currency am I buying? I'm actually using 0.3. I'm actually using 0.3. So out of that 0.3, based on the quantity of currency I am buying in the market of gold, I am actually using a margin of 115.61. So should I be using like 0.6? It means that I'm using, let's say, multiply by 2 of that, right? Now, the margin actually helps you or cushion you not to waste the leverage opportunity given you. Okay? So when you are in the trade and the trade is going against me, let's say the value here you are seeing is negative, you will not see the same margin movement as well. It will be reducing. Okay? Now, let's say you are having $100, or let me use $200 or $300, and then you take the same lot size, 0.3 I took. Your margin calculation will be different. Okay? It also means that if this trade were to be in negative 106, you are automatically losing like half, or market is against you, half of your equity. So your margin level would have been 50 and below. Right. Now, as we start practicing, some of you will actually learn what is multiple entry, where you'll be able to enter trade multiple times, like that's 0.3, you're seeing it times 10 or times 20, right? There are some people too, I hope nobody does that though, but then they will actually enter the trade when market is not going in their favor, they want to add more entries. Some people also like that, right? Now, when you are doing that, and the trade holds in negative, your margin level reduces. Your margin level reduces. Your ability of what you're supposed to eat or what is supposed to protect you to hold the trade will reduce. Why? The trader, the broker is not responsible for your losses. And the broker cannot afford to lose portion of that backbone money they give you as leverage. The broker cannot lose a portion of it. That is why the margin comes in, to protect the broker at the same time, protect your decision making too at the same time, right? So if you are taking a trade, you need to actually have in mind how many lots you can use per your account in relation to how your losses will be in relation to the condition of the market. Okay. Aside price hitting your stop loss, the bonus you can use to also lose money is called margin call. At that time, you are just going to receive an alert on your phone that your risk is too much. We can't bear it anymore. So broker will actually force to close trade for you. That is why some people still lose trade and hold negative, because by the time the broker close the trade for them, they eat into the leverage amount or the leverage opportunity they give them as well. All right. So please, leverage is actually an advantage to brokers, but then you need to add that up with margin. so that you can be in business and your broker will also be in business. So thank you so much for your time. And then we are going to end it here. If there's any question, we take it, then we'll call it a night. So I hand over to Mr. Clement from here. So if there is any question, you can raise up your hand and then we unmute you, then you ask question.